Hey everyone, welcome to another video. Today we're covering an absolutely incredibly important foundational topic to being a successful trader. Whatever being successful means to you, risk management is the key to being profitable. At the end of the day, you could have a solid strategy, but bad risk management, and you'll find yourself to flop. If you have a bad strategy or you're still working on improving your strategy, but you have good risk management, you'll still be in the game long enough to improve and see the changes happen. And so this is one of the first things that I think many traders learn the hard way. When I first began as a trader, I was risking 5, 10, 15, 20% per trade, and I've had multiple accounts that were completely blown up, and I've had to keep funding trading for the first year that I was doing it. I would still have to put money into an account because I'd be blowing up accounts. I probably blew up like 5, 6 accounts until I was able to start pulling profits away from the market, right? And that came down to having a solid risk management strategy. Now, I think it's often overlooked. Many communities and courses are specifically going over this and mention that you should never change your risk per trade. And they tell you absolutely don't trade your risk per trade and keep it at 1% or keep it at 0.5%. And that's it. They're complete absolutes. And I think anytime somebody gives you something that's absolute, you should always question it. Because there's a lot of things when it comes to trading that being creative and anything that has to do with strategy is about constant testing and constant improvement. And anytime you have an absolute and you stop thinking about how you can improve it, that's going to be an area that you're just going to constantly neglect. So instead of listening to somebody else, figure this out for yourself and use this as a guide. I'm going to show you dynamic risk management, which is something that I don't think you probably heard before because I've taken plenty of other courses and nobody says anything about this type of trading. So these are two ways that I have in the past used and one that I'm still currently using right now. This is something that is super important to my trading, and without this, I would not be going in the direction that I would be going now. Remember that when it comes to trading, you never want to compare yourself with somebody else. When it comes to trading, your self-improvement is the priority. It doesn't matter how much somebody else is making, how much percentage profit. Don't get lost and distracted by somebody else's trading because they started at a different time. They might have a different method, and they're not always going to show you everything. They're just going to show you the best parts of trading. And so when it comes to trading, you have to focus on self-improvement and not getting distracted by what other people are doing. Hopefully, this will help you. In particular, these methods are great for people who have trouble of entering due to fear of missing out, over trading, being on the wrong side of the market, still not having a solid winning strategy, and people that simply just haven't questioned why we should do certain things differently, right? And so this will kind of open your eyes to a couple of different ways of doing things, and hopefully you have a lot to gain. Now, this is something in particular that I've noticed a lot of people are messing up, whatever experience level they are. I've been doing a lot of free coaching calls, one-on-one. I give away a couple a week in my Discord group. We started less than a month ago. I have about 150 super awesome, super engaging members. The community is amazing. So I did that by request. If you want to join that, there's a lot of exclusive stuff that's just in Discord, and I answer questions there every day. On top of that, I do live trading sessions. And then we also have, what else do we have? I give away free coaching in there. So if you want to join, link is in the description. I totally recommend you check that out. So let's get into this video. First things first, we're going to take a look at the top right corner. This is a little thing that I just wanted to remind you. Trading is not all about flipping accounts. The focus of trading should be constant improvement and refinement of one's strategy to improve the win rate and the risk to reward for every single trade. Focus on capital preservation. Profitable trading strategies require a win rate and a risk to reward rate that is positive, and both can always be improved. Whatever you are trading, if you're trading your own money, whether it's your last $100, whether it's $1,000, whether it's money that you've borrowed from somebody else, whether it's a funded account, one of the most important things is to master and focus on wealth preservation. You do not want to lose your accounts. The markets can stay irrational longer than you can stay solvent. I've heard that somewhere. I don't know where it was. I don't remember it, but that's something that I've always remembered and that I think is important to remind other people about. So I'm going to go over 2 different strategies, and I'm also going to go over what a week or a month of trading can look like based on your win rate and your risk to reward, right? And so these are going to be things that will help you get a visual on what you can be doing and what you should be aiming for, right? And so, like, obviously when you first begin trading, you might not be seeing the results that you're looking for. And that means that, guess what? You just have a long way to go. You can start improving yourself, and you can make these higher win rates and these higher risk to reward trades your goal. That's something that you should be pursuing. And so we're going to go over a couple of different things. The first thing is I wanted to go over 2 methods to prevent your downfall with losing streaks, right? And so, like I said earlier, a lot of courses and mentors or whatever in trading will constantly tell you, do not trade or do not change your risk per trade, right? They're giving you an absolute there. And then what else are they telling you? I think that's like the main thing is they're telling you not to trade it, not to change your stuff. And so I think that dynamic risk management is incredibly important, and that's what this is about. So if you suffer from fear of missing out or emotional trading or losing streaks, which we all have losing streaks. Don't let anyone tell you that we don't. Whether they're 2 or 3 losing streaks or you have more, right? There's ways to protect yourself against them. So let's go over strategy number 1. This is a corrective strategy. The strategy number 2 is a preventative strategy. So strategy number 1, I call it 3 strikes, half your risk. That's a simple explanation. You probably already understand what you're supposed to do based on the name. So I'm going to read it over, and if you want, you can skip over to other parts of the video. So strategy number 1. This method will help prevent the emotional toll that occurs when losing streaks begin. If you suffer from overtrading or being on the wrong side of the market, as these faults result in substantial drawdown. The risk management method will quickly prevent your losses from adding up before the streak even begins. This method requires discipline but is easy to follow. Whatever your risk per trade is, for example, let's say your risk per trade right now is 1%. Whatever it is, we're using this as the example. If your current risk per trade is 1%, when you hit 3 losses in a row, which is a negative 3%, 3 losses at 1% is minus 3%. Immediately cut your risk per trade in half. So we're going to move from a 1% risk per trade to a 0.5% risk per trade, right? And while you may see this as counterproductive, because you might be thinking, hey, if I'm wrong 3 times, I'm probably going to be right my 4th time, right? That's a constant flaw that we have, is thinking that the next trade is going to be the one that makes all of our money back. So instead of thinking like, gosh, like I'm down and start revenge trading, this will put an end to your building up of losses, your losing streaks due to revenge trading, right? So instead of thinking like, okay, it's going to be, in this case, it'll be counterproductive thinking that if I half my risk and my 4th trade is a winner, right, I'll make my money back plus profit, right? Well, typically, someone that's taking 3 consecutive losses shows that likely the trader is either on the wrong side of the market or is trading out of emotion. Realistically, you shouldn't be taking 3 losses in a row. When I trade, I'll typically take in an average session about 3 trades, and I'll usually have one loss and 2 winners, right? Or I could have two losses and 1 winner, but I'll typically always have a winning trade, and that trade will usually make everything back plus, 10 to 20 R per day, right? And so when it comes to this strategy, the reason why this is important is because if you are trading the first trade, you can lose the first trade sometimes by being early, right? Or by missing or basically by targeting, let's say, if you have a decisional set as a limit and price comes to the extreme, totally understandable to take the first loss. The second loss, maybe you even got swept out of the second POI. So let's say it took you out of the decisional, came to the extreme, you entered pretty quickly, and it swept you. So now it swept the extreme. There's 2 losses, right? And let's say now you get another signal telling you that, okay, it's time to get into another trade. And so now you enter the 3rd trade, and now you hit a loss. Likely, what's going to happen is if you are taking 3 losses in a row, likely you're getting in way too early, and you are going to probably start revenge trading, because at this point you're pretty upset that you already have 3 losses, and you're going to start hitting, buy or sell button too many times. And so this method is going to save you from having a buildup of losses. And the reason why is because if you are taking 3 losses, you're on the wrong side of the market, or you're trading out of emotion, likely, right? And so even if you take, let's say in this case, even if you took 3 more losses, the impact of the next 3 losses would add up to only, at 0.5% risk, you're going to have 3 losses. That's minus 1.5%. So when you are risking 1% per trade, you hit 1 loss, 2 loss, 3 losses. Like in the example, you're down 3%, right? If you are wrong the 4th time, right, then guess what? You're going to be wrong 4%. And then if you continue, let's just say you hit 6 losses in a row. At this point, the first 3 were early, the 4th, 5th, 6th one were revenge trading. You hit 6 losses in a row, and you haven't even been phased by that. That's a lot of drawdown that you're experiencing. 6 losses in a row is way too much. And so instead of being down 6%, if you hit the first 3 losses, you're gonna half your risk. So instead of being 1% risk, you're now going to 0.5% risk. Now this is drastically gonna help you, because look, 3 more losses from 3, trade 4, 5, and 6. Let's say you hit 3 more losses. Instead of being down 3%, and for 3 whole trades, you're technically only going to be down 1.5%, which is 50% that you'd be saving yourself from, right? Now, this would allow 6 consecutive losses to have a total impact of minus 4.5% instead of negative 6%, right? Now, let's go to the extreme level, right? If one was to experience 6 losses and we half risk again, from 0.5% risk to 0.25% risk. Let's say you now experienced 9 losses. Instead of being down 9%, which if you're on a funded account, likely you probably are losing your account at this point, right? Or if you are, let's say, on your own money, you're down 9%. That's a pretty big hit sometimes. And so that could definitely be stressful. And so using this strategy, instead of being down 9%, you halved your risk twice you went from 1% to 0.5%, and from 0.5% to 0.25%. Now, with 9 losses, you're only down 5.25%, which is a little bit more than just losing 5 trades. That's drastically helpful. I mean, that's about 50% of what you would typically be losing. That's a massive help, right? And so trades 6 to 9, you lose those 3. Your total drawdown from those is 0.75%. That's half of the previous 3, right? Now, and hopefully you're not lost at this point, right? This is particularly helpful when trading funded accounts. We only shift our risk back to normal, right? Because at this point you're wondering, after I've halved my risk, when do I go back to normal? Well, we do that when we are either out of original drawdown, or we move up to the previous risk when we cover the loss of the previous 3 trades. This means if we have a 10R trade, let's say you've had 9 losses, you have a 10% win rate, whatever. Let's say you have 1 winning trade at 0.25% risk, and you're, at 0.25% risk, you hit a 10R trade, which is totally doable, right? And that makes sense for the way that I'm showing you how to trade, right? At 0.25% risk, 10R is 2.5 total percent gain, right? And so at this point, you were down 5.25%, and you just basically cut that in half by adding 10R at 2.5% with only 0.25% risk, right? So that actually would cover the first 6 losses. And so now you can choose to go back up to cover those 6 losses. You can now go back up to 0.5% risk until you recover the remaining 3, which would leave you needing only 6R. So in this case, instead of ever being down to 9% drawdown, you're down at 5% drawdown. And every time you take 3 losses, you're halving your risk. Now, you should not be taking 10 losses in a row or more than that. You really shouldn't. At that point, you really have a problem with your trading strategy, and you should pause, right? But should that ever happen, because it can happen and it likely will happen at least once or twice, right? Having your risk is going to protect you from being an emotional wreck when you begin adding to your losses, because it can get really stressful. And revenge trading can be really bad. So using this type of method, right, you can basically, let's say for example, you're 9 down, you have a 110R trade, you now covered the risk of those 6 losses. So now you're moving back up from 0.25% risk to 0.5%, right? Now you're only down the remaining, like, I don't know, like what, less than 2.5%, less than that, about 2%, 3%. So now you only need about 6R at that 0.5% risk to go to positive balance. Once you are in positive balance and in profit, you continue with your default risk per trade, which in this case, let's say, is 1%. So you continue doing 1%. Let's say you're 10% in profit, right? So you're in profit, you took 3 losses, you're down 3, right? So you're at 7% profit, you half your risk again. This is going to be a very corrective strategy that's really going to massively change the way that you trade. It's going to help you, and it's going to eliminate a lot of the stress from building up drawdown, right? Strategy number 2. This is about starting safe, building the buffer, and this is a very good preventative strategy. Number 1, very corrective. Number 2, very preventative. I prefer to do the preventative strategy, and I have a combination of both. Whenever I trade a bigger account or my account gets to a new milestone, I will do the preventative strategy. And when I basically am actively trading, once I create the buffer, I will then move back to a corrective strategy. And so if I have 3 losses in a day, I call it a day, right? And then the next day I start with my half risk, and that it's drastically helpful. So strategy number 2. This method can be considered the wise way to start trading. When there is a level of intimidation when we begin trading new accounts, larger accounts, or prop trading accounts, this strategy allows you to get comfortable and in profit to give you a buffer before any changes are made. This method is great for someone with a solid strategy who struggles mostly with the emotional aspect of drawdowns. This method prevents the stress that occurs in the beginning and maximizes the profitability when winning streaks are had. And so how do we do this, right? Whatever your starting risk is, typically start by halving it. Having like half, right? If we usually begin with 1% risk per trade, we will now default to trading 0.5% risk per trade. We will keep this until the account has built a buffer of 10 to 20% profitability. This 10 to 20% profitability buffer would take about 20 to 40R at 0.5% risk. So that's just a couple good trades, right? And so the idea behind this is, once we find the account sitting at 10 to 20% profit, we can now move on to the full default risk from 0.5% to 1% risk per trade. This strategy focuses on building a profit buffer, so instead of correcting ourselves when in drawdown, we can do our best to take preventative measure and have peace of mind that we can, even with a 10% win rate, allow our account not to drop into drawdown from the original balance when targeting 10R trades, right? Or if you have a 20% win rate with 5R targets, right? So note, this is an important part. If drawdown occurs or price returns to the starting balance after withdrawal or due to losses, right, we begin the process again until we rebuild the buffer. So let's just say you have a $10,000 account and you're sitting at 1,000 profit. You're at 1,000 or 10,100, 10,000. You're sitting at 11,000. Sorry, my math. I've done a lot of math today. So you're sitting at 11,000. Your starting balance was 10,000. You have that 10% buffer. Let's just say you had a good week. Now your account is at 12,000. Let's say you want to withdraw $2,000 and go back to your starting balance because you want to lock in your profits. So you take 2,000 out, you're back at your starting balance. That would be one scenario. Or let's say you were at 10,000 starting, you made it to 11,000, but you had too many losses, you came back to your starting balance. Whenever you are back at starting balance, we begin the process again. So you must build back the buffer again before you go to default risk. So the buffer should be minimum 10 times the default risk. The example here is if your default risk is 0.5% risk per trade, then you should be having your risk to 0.25% risk per trade until 5% or more is created as a buffer. If you risk 1% per trade, right, you're going to half your risk to 0.5% risk per trade until you have a 10% plus buffer. For 2% risk, you're going to wait until you get to 20% plus buffer. And so both of those are going to be dynamic risk management strategies. Incredibly important life hack when it comes to trading. Hopefully those are helpful, and one of those might help you either to think and make your own strategy or to adapt to one of these methods. One thing to look at is if we look back to the bottom of the chart here. Now, what does 1 week or month of trading look like? Every trader is different. These might not be your goals. You might have different objectives. You might have a different win rate, a different risk to reward target. I know some people trade like a 1 to 2 hour trades or like 3-4 hour trades. You know, that's wonderful. Whatever works and makes you money, that's what matters, right? Now, to give you an idea of the type of trading that, let's say, like I'll do, and a lot of the people in my group do, because we all have a similar method, right? For example, what does your risk management look like? For somebody that has a 0.5% default risk, or a 1%, or a 2%, right? So let's just look here. If you have a 0.5% risk per trade, right, and you target minimum 5R trades. So let's just say no matter what, you always take profit at 5R if you hit 5R. If you have a 10% win rate, you're going to be sitting at the end of, let's say, the week or the month or whatever. If you take 10 trades out of 10 trades, you're going to be sitting at a loss of 4%. If we look across the board, you kind of see here that and you'll have the 5Rs on top and the 10Rs at the bottom. If you trade to a 5R target out of 10 trades with a 10% win rate, you're always going to be sitting at a loss. And so the goal is to never have your win rate be so low that it's below, or that it's at 10% or lower. Now, if you target 10R per trade, right, with a 10% risk, you will technically be sitting in just basically 1 R of profit. So you'll still be in profit and you'll still be in the game, right? So just as important it is improving your win rate, it's also improving the risk to reward, right? If we, for example, look at, trading 1% risk per trade, here you can get an idea of what it looks like. These tables, you can review them on your own too. The description to this cheat sheet, or the link to this cheat sheet, is going to be in the description. Remember that. So here we see with a 1% risk, if we trade 5R trades, let's say you got a 30% win rate, and for the week, right, you have 7 losses, right, and 3 wins at 5R, which is a total to what, 15R of profit, or 15R total. Your ending result at 1% risk per trade is going to be 8% profit. And so we can quickly see how improving our win rate, right, even with the same risk to reward, is drastically going to multiply your account. Personally, and I don't recommend you do what I do, because every person has something that fits their own plan, I always risk 2% per trade. Now I take a corrective strategy on mine. In my case, I half risk down to 1%. So I'll go 2%. If let's say I hit four losses, the first 3 losses are going to be 2%. After that, I will always just keep it at 1%. I should not have more than 3 to 4 losses, but if I do have a losing streak, then I will keep it, at 1%, having my risk from 2. So typically what I aim for in a good week is I'm just aiming to, let's say, double my account, and that's pretty realistic. So what does that look like? I don't take profit unless it's 10R minimum. I do not care about 5R. Unfortunately, 5R for me is not, I don't target 5R in my strategy. My own strategy, it has to hit 10R or above for me to take profit, or else I don't take that trade. Now, based on my win rate, right, I only need to have a 50% win rate to pretty much double my account. And that's not bad. 50% win rate is very average for the type of strategy that I trade. So now if I risked, let's say, 2% risk per trade, right? Let's say I'm winning my trades here and I'm in the 2% bracket, right? let's say I hit 5 losses, but I hit 5 wins. My losses will be 10% drawdown, right, in this case, but my profit is going to be about 100%, right? Now the net of that is that I'm going to make 90% of my account in that 1 week. Now, maybe that sounds crazy, but there's a lot better traders out there that are doubling their accounts in like 2-3 days. It's not unrealistic. It depends on your win rate and your risk to reward rate, right? If I was only taking trades at 20% R, right, and I had a 20% win rate, I would still be making really good money. If I was making, let's say, 30% win rate and I had 20 R trades minimum, I mean, you're still making really good money there. I mean, that's double, right? So the idea behind this is to understand, where you stand. Now, if you half your risk, let's say like me, let's say I took 3 losses here, and now I'm moving to 1% risk per trade, right? 1% risk per trade at a, let's say, average of 50% win rate or above is still very good. I mean, it depends on how many trades you're taking, right? Realistically, and obviously our risk or win rate is going to be very dynamic and it's constantly changing, right? For example, you might take 3 trades in a week and all of them were winners. You might take 7 trades in a week and you had 4 losses and 3 winners, and those 3 winners might be 20 R, right? So the idea behind this isn't that this is exactly what your trading looks like, but to give you an idea how important your win rate is and when you have a solid strategy, right? So like, if you know where you are in your win rate, pay attention to what your targets should be. If you're not setting, let's say, quality targets and you're constantly missing your target, maybe it might help you to set a solid take profit. I don't do that, right? Mine is always set based on the, let's say, points of interest, right? So I'll trade from one POI to the next one, right? But if you take profit at a solid 5R and you're trading 1% risk per trade, and you're even, let's say, winning 30% of the time, 8% profit for each week is incredible. And if you're on a funded account, that's really good. So hopefully this little tablet here, or this little chart here is helpful, right? So pay attention to that, see where you fit into it, and set your goals for where you want to be, right? Now, the next little tip, this one is part of risk management, but it's more about trade management, like active trade management. Something that I encountered during one of my trading coaching calls was about people taking trades and getting stopped on break-even trades. And one thing that I don't like to do is set a absolute break-even kind of trade. So a lot of times what I'll do, and it depends, right? Let's read the actual description here that I have, right? So leaving behind POIs after mitigations, the flaw of setting trades to break even. So trade management tip. It is often forgotten that when we take an entry at an unmitigated POI, oftentimes the entry that mitigates can leave behind a new unmitigated POI that sits at or above the current entry. For this reason, many traders who set their trades to break even are often swept only to witness price then move and hit their take profit without them. So how do we solve this common problem? Because it happens to everybody, right? This is how we can typically prevent this type of thing. We solve it by instead of setting the trade to break even, we cut down the stop loss to cover the newly formed POI that caused the break of structure, right? So typically what most people trading are going to look like is, let's say we're taking shorts, right? Price comes in, taps the POI, you're in, right? Whether this is a risk entry or a lower time frame, double confirmation entry, whatever it is, it doesn't matter, right? So we tapped in, but maybe even on a slightly higher time frame than your entry or at your entry time frame, we actually, upon mitigation of this POI and liquidation of a previous point of structure, what do we have? We can leave behind a extreme or a decisional flip POI. And so if you take a trade entry here, you get this break of structure to the downside. Now you're going to think, well, likely this is going to be protected. And so oftentimes people will set their trade to break even after the first break of structure, right? But the thing is, remember that price will constantly mitigate POIs. And so if your trade and the entry is sitting just below or at an unmitigated POI inside that new formed leg, right, on this one, lower time frame, price can come back to it. And so if we set our trade to break even, right, like this, now we're going to be stopped on a trade that we were correct about, and we could have stayed in to capture all that profit only because we set our trade to break even and price came back to mitigate that newly formed POI. Same thing with when you're going long, right? Price pushes to the upside. We have a POI left behind here. Price comes in, taps it, gives us a break of structure on here, gives us a change of character. We now set our trade to break even, and price comes back. And we get stopped after it comes back to mitigate the newly formed POI. So, excuse me. So the trick to this, instead of setting your trade to break even, set it to cover the newly formed POI that broke structure. So instead of, let's say in this case, instead of having a, let's say 18 pip stop loss, we can cut it to the top of this, and now we have a 9 pip stop loss. 9 pip stop loss. So we've now halved our risk. Instead of having a trade break even and taking home nothing, we cut our stop loss in half. And that's very common to do as a trick, right? Let's say here we have a 21 pip stop loss. We now cover that new POI that broke structure. That's the keyword. It has to break structure, right? Change of character. We now move it from the original 20 pips to like 6 pips, 7 pips, right? Now, I get that this chart might be a little bit confusing because this is just, me drawing some up perfect scenario, but let me show you an actual scenario, right? So here we are. Let's look at this. We are going to look at this on the 15-minute time frame. Let's look at this point of structure here. We can see here, for example, we have this low, we have this high, price is already pushing lower. Here we can kind of see that we have what? This point, and if we look to the left, I didn't draw out all of the structure here. But let's do it like this, right? We have this demand, right? Price gives a reaction to demand, forms some extreme, comes in to tap this supply, supply's in control. We break this 15-minute point of structure. Now what do we have? We have this area where we might have some interaction, and then we continue to the downside. Overall, we know that price is probably going to come down to this target, right? So now we're looking for our entry, right? So what are we looking for? On the 5-minute time frame, right? What do we see here? We have this POI that was a demand. Price came down, tapped this POI, basically swept liquidity to the left, and then broke structure. And so what do we have? We have a sweep that breaks structure, and this forms a flip. You can see it more clearly here. Sweeps liquidity, breaks structure. Full candle body closure. So here what we're seeing is a flip entry. And so you might have a couple rules for this. Maybe your rule is that you're going to enter at the 50%. Maybe your rule is that you're going to enter at the 25%. Maybe your rule is that you're just going to enter at the open, right? And so technically, we could have gone in on the trade from here, right? But let's say we were waiting for some more confidence, right? This is not enough because what? Price could technically come all the way back up here, right? So this break could happen and then we have price pull back. Once we see price leave behind all this imbalance in here and break structure to downside further, we can bet that likely that this flip hasn't been truly mitigated and price can still come into here, right? At the same time, price can come in and tap this POI. We don't know yet, right? So let's just say we set our entry here at the open and stop loss right at the top, right? And so originally we're looking to take this level out and even target even further, right? And so based on our rules, price comes in, taps us in, and then you can see we left behind such an aggressive wick. That's telling me that likely there's a ton of sell orders that have been stacked up here. But as price pulls down, we don't break structure. We can see the price comes back and now leaves a little wick here. So at this point, I'm a little bit confused because I'm like, hey, I'm entered into this trade. I see a massive wick that looks like it's swept to the left. I think this is going to keep holding on. I'm just going to set my trade to break even because I don't want to risk taking a loss if I'm wrong and price pulls up to the better POIs here, right? At this point, what happens? We get one more tap, takes us out, break even. We have another tap, break even, right? We have 3 taps after we get entered in this trade to the same POI, right? Whether you're at the 25%, you're going to get tapped 2 more times. If you're at the open, you're going to get tapped 3 more times. So how do we do this? Same way that I said it. Instead of setting your trade to break even, this trade has a 4.2 pip stop loss. Let's just cover the most recent POI. This might be a better POI on a lower time frame. So now let's cover this high. So instead of having 4.2 pips, let's have 2.5 pips. So after this gets tapped and triggered, we pull to the downside. Let's say on our entry time frame, right? Or at the 5 minute if we set a limit. We're seeing this and we're like, okay, we can see that now we have what? We have this, almost looks like a sponsored candle, but we still have a little wick above, right? That sweeps liquidity to the left and then pushes down very aggressively. So at this point, instead of doing this, I'm just going to protect this. And the reason why is because price could come back, even if it's not fully committed, to still come back and tap the equilibrium of this or tap the extreme, right? Whoops, I'm looking for the proper tool here. Should be this one. Price could still come back into the EQ, or it could come up a little bit higher. And if that happens, I want to be protected, right? And so what ends up happening? As a result of this entry, price comes back to tap the extreme. Notice how instead of breaking even and taking, multiple losses with re-entries, we simply just covered the most recent high. You cover the high plus your spread, whatever, right? Look, price comes in, taps it, pushes down further, right? We're basically building liquidity here, right? Because we have yet to break structure down here. Price pulls back down, and then what do we have? Another mitigation here at this POI, because what? This POI mitigation, right, left behind another POI in here that was untapped. We left behind this POI. Let's mark it out. So then what happens? Price looks like it commits now. So now what are we doing? We're breaking structure to the downside. But now what do we see? Gosh, well, we didn't get a break and close below here. Looks like we have a sweep. So we're kind of unsure. Price could take some liquidity. Price could continue to the downside. But when we see something like this, we're still thinking like, gosh, well, price should come down here, but it could have a pullback. Where could it come back to? Well, we have this POI, we have this POI, and maybe we have the wicks in here, right? Maybe these wicks could still be mitigated, right? We never know. So price is hovering in here. Instead of taking the loss, you're still in this trade. Price comes in and does what? Boom. Sweeps liquidity from 1-2 previous taps that did not break structure, but still respects this newly formed POI extreme wicks. And so this is how we prevent losses with break-evens. We're still on this trade. Now we have to risk. If you're risking $100 per trade, $50 per trade, $10 per trade, whatever, it's better to take the profit, right, and stay in a trade than to be very aggressive with break-evens because oftentimes you're going to forget that price will form a new POI when we create a mitigation of a previous POI. It happens all the time. That's why we get multiple taps to the POI, right? So this one finally sweeps those 2 previous ones, but respects this one. We've half risked, right? And technically, this one should not be breached, right? It should not be breached. So this one respects it and then pushes to the downside. We get a break, right? And we know, let's say we're targeting this low down here from the 4-hour, right? And so let's say this is our target down here. And let's just put it like right there. And so this trade that had let's say that we originally set with a 4.2 pip stop loss that's worth 10 R. Instead of taking the loss, right, or taking a break even and catching nothing, right, and then getting stopped out of re-entries, because most definitely you would have re-entered off of the other POIs likely, and you would have ended up taking 2 losses, 1 break even. In that case, it would have been better to just half your risk, take half of it off the table by having the risk, cover that newly formed POI that stays protected, right? Even with multiple taps to the POI, it's not going to violate it. and then you still catch the trade and you take all that profit home, right? So that's a little tip that I have. Hopefully this video was helpful to you. Where is this zone that we're looking at? Here, this is what we're looking at, right? So the summary of this: dynamic risk management is incredibly important. There's no absolutes when it comes to trading. Always focus on improving your win rate, and your risk to reward. Pay attention to where you are, set goals for yourself, constantly improve, and have realistic goals for your trading. If you don't have good profit targets, set solid profit targets. Set solid take profit at this R, right? Minimum, right? Or, really be good with your type of strategy. If you are just taking the same risk per trade forever and you're only doing 1% and 2% risk per trade, consider maybe having one of these methods implemented. These are probably going to fix a lot of the problems you're having. And when it comes to trade management, a little tip for not taking break evens is to consider covering the new POI that has been formed from that new leg, as long as it breaks some level of structure. Hopefully this video was good. Hopefully you learned something new from here, and if you have questions, send me a message. If you want to join my Discord for free, just click the link in the description. Wonderful community with over 150 members in the last 1 month alone that we just started. Super cool. So look forward to seeing you for the next video, and have a beautiful weekend. We'll see you next time.